Why are restaurant chains still having challenges in 2025? Hello, this is Jonathan Mays, editor-in-chief of Restaurant Business. And in this week's episode of A Deeper Dive, we are taking a look at the state of the restaurant industry. A lot has changed in just a couple of months so far this year, a year many of us thought would be a lot better than 2024 was. Yet we continue to hear concerns about industry challenges and low-income consumers cutting back on their dining, more value wars and sales softness that goes beyond just weather. So I roped in Technomic's Rich Shank to talk about all this. Rich, welcome to the podcast.
Thanks for having me, Jonathan.
All right, what's going on? I thought this was supposed to be a better year. Why isn't it?
I think we all thought that same thing because we were seeing a lot of momentum going into November, and that certainly did not happen even in December. So December, our traffic numbers looked negative, and then in January, and I think there's a number of reasons. Some of them are related to the election. Some of them are related to some of the outcomes of the election, and then others are, people's pocketbooks are significantly strained and they're worried about the future. Some of that is all related, but so I think all things being equal, we did not anticipate consumer confidence taking the dive that it did, to be honest.
It's taken a nosedive in February. Yeah. And commentary from several different executives, a pretty varied group, in fact, has really pointed to a consumer that is still in sort of this cutback mode. And, and we contrast that if we go back to early October of last year, things were looking up. Wendy's said that their early quarter same store sales in October was really strong. They had a very, very good SpongeBob promotion, which apparently drove their sales up 10% in that month. McDonald's, before they had the whole E. coli thing, was doing really well with the chicken Big Mac. We had other brands doing really well. Burger King was doing well with its Whopper, and everything sort of fell back into December. And now we're sort of in the same pattern that we were in for much of last year, where we're seeing this softness, particularly in the fast food space. And this as well as I do. I mean, early year numbers are almost useless most of the time. But what we're hearing over and over again is it goes beyond just weather and other stuff.
So I think and you and I have talked about this before, even in a good year, our market is a bit soft because we're not getting a lot of new mouths to feed. So, traffic at best is going to be up by a point, generally speaking. And so there's not a lot of room for slippage. And so if you add in a fatigued consumer on top of, in a normal election year, the consumer confidence numbers tend to be partisan. And so when there's a change in administration, the party that wins gets more confident. The party that loses gets less confident. We did see that pattern here, but now with the last month and a half of news, it's becoming a little less partisan when it comes to like who's less confident in the market right now, because there are people that are actually being impacted by some of the layoffs that we're seeing in the government, and then the cascade effect that has on other markets. There is that sort of unusual impact that we're seeing with what's going on with our policy regime at the moment. So
right. I mean, the big issue is tariffs, and they haven't gone into full effect. It's basically been a series of threats for the most part. And, but he continues to make those threats, and look, I mean, tariffs have probably a bigger impact on grocers than they do on restaurants.
They do.
Because a big food cost, the food cost, I mean, this food costs tend to, be a bigger problem for grocers and for restaurants. Right. When labor costs become a problem, but the other side of this, the other side of the tariffs, I am less concerned about tariffs and far more concerned about immigration as a rule. And I don't like the idea of restricting your labor supply. And
it's going to make it hard to hire if there are people that are concerned about their immigration status, even if they are here legally, that's sort of cooled their ability or willingness to participate in the market. right? And so that's definitely having an impact. I mean, here in Chicago, we can see it on our streets sometimes, right? So that's something that is certainly a challenge. I think on the tariff front, it's more about the uncertainty of the environment than it is the actual tariffs, and people are responding to that uncertainty by not acting or buying. And so that can be on both the operator side of the business when they're thinking about their plans, but also the consumer side. As I mentioned before, that sort of partisan nature of consumer confidence around election cycle. Let's just imagine folks who aren't happy about the electoral outcome. They've sort of set on their hands a little bit when it comes to where they're spending and how they're spending in this market, because they're the ones that have the biggest fear about where the future's going. And that's a pretty big chunk of the market. That's impacting not just restaurants, but it's impacting places like Target and other places like that as well.
Right, right. Well, I mean, what we're having, by the way, as we speak, and we're recording this on Monday for you listeners, the Dow is plunging because now there's concern about a recession. I mean,
right.
Honestly, we were not that long ago not worried about a recession, and now we're worried about a recession again. If we start getting into this whole economic downturn situation, I mean, one of my concerns still today, and the issue that we have, the issue that the industry has had for really about 2 years, is it doesn't have any pricing power. It doesn't, period. End of discussion. I don't, it's why everybody's doing these value offers from Subway to McDonald's. And I mean, does that concern you? Like if the industry doesn't have any pricing power, but we start seeing some of these costs go up, or you end up in a recession, I just don't, I think the industry is in a lot of areas just not really in all that great shape right now.
So I've just published our year-end sort of traffic update, and I like to compare to the pre-pandemic time when it comes to where traffic stood from a holistic number of transactions standpoint. And if you look at what happened last year and you net out all of the growth between 2019 and this year, we've only grown traffic by 1% since 2019. Right? You add what the check average growth over that period was, is 30%. Right? Like, given we're sort of sitting at this precipice of a pretty unprecedented price sensitivity problem in many ways, like where's growth going to come from? Because it's all come off of pricing actions in the last 5 years. And so, that does put us in a bit of a pickle. In November, we were optimistic that things like, a balanced government would sort of check some of the temperature on some of these tariff conversations and immigration conversations. And that hasn't happened yet. It may, but it hasn't. And so, those things that we were hoping were kind of will sort of moderate the environment hasn't really occurred yet. And I don't think that's working in our favor either.
Right. Right. I think one of the surprises, if you look at total restaurant sales last year, the U.S. consumers spent 53% of their food dollar at restaurants, which, by the way, is, in 2019, it was only 50%. And so historically, that 53% was relatively high. And I think, one of my theories is that the consumers saw how much they're spending at restaurants. And, they realize, they know that they're spending more on restaurants generally than they historically do. And then they see the number of times they're visiting, and it's bothered them to a great degree. And, so yeah, I mean, I don't think the industry has pricing power. On the other side of it, I don't think I don't really think that the margins are so great that the industry can continue to afford a prolonged value war either.
Yeah, at the same time, you have some companies saying they're going to absorb any of the tariff impact. Not very many of them can really do that either, right? So that's where there's sort of this double bind, and, how do you move forward? And the standard advice has been like, go up and down your SKU list and figure out where your risks are from a tariff standpoint. But it's not just tariffs that are problem, as you point out, because what happens with your labor supply, what happens with your customer base too, because immigration is the primary reason our population's been growing over the last several years. So where your customers are coming from is also an issue. So that becomes a big challenge, and it's really hard to see what the way out is without being very innovative in our thinking, right? So, and I start thinking about which brands are actually showing good growth this quarter, and they're not necessarily going into deep discounting mode, and they're not panicking over this uncertainty. They're sort of doubling down in the investments in their brands. I think about Taco Bell doing very well in this first few months of the year, and then talking about doubling down on innovation. You wrote this article that I thought was really poignant about in that point, and you're seeing a similar trend line for brands that are growing well. Chipotle is another good example. They're sort of bragging about being able to take the tariff hit, if you will, but they're doing other things to mitigate the costs and drive growth. And a lot of that is investing in new ingredients. Their honey Chipotle chicken is a version of that, where you can swap your products in and out, and maybe have a less risky product in the next quarter that's driving new traffic, those sorts of things. But not everyone has the power to do that, but it's still those brands that are in a position to invest in the core identity of their brands. Taco Bell being an innovation focused brand, perfect example, I think. Not panicking and going down the rabbit hole of discounts all the time, or cutting the menu back to where it's almost nothing. Of course you need to streamline your operations and things of that nature, but you also have to have some things to sell, and some cool things to sell in order to keep people in the market.
Yeah. So, yeah. Well, I think Taco Bell can do that. I don't think a lot of brands can do what Taco Bell is. They're very, very, very few. They've got this gorgeous menu where they Mexican. It's actually similar to Chipotle, because, Chipotle, I think one of the beauties of Chipotle is that you can customize the hell out of your menu and not screw it up. You go to Subway, by the way, you get a sandwich, and you can totally screw up your sandwich.
Oh yeah.
I challenge anybody to screw up a Chipotle order with Chipotle ingredients. You have to try pretty hard.
Well, I do think that, Subway's, Subway series menu helped at least for a short period of time in solving some of those issues, because they were able to put their best foot forward on the menu and things of that nature. But, it lost a little bit of steam after a while. You got to find new reasons all the time, right, to be able to do that. That's what, Taco Bell can afford to make those investments, but it's a pretty, interesting thing to watch, because that particular cuisine type really was the only one to grow last year.
Yeah, it was. If you look at, the challenge that we have today, and if we start facing a prolonged, or an extended, sort of recessionary situation, is that a lot of brands are sort of in this discount and cut sort of mentality, where and they might not necessarily be the ones that are cutting, but you will get a lot of brands that just start discount the menu because that's the only way they can think of getting people in. And then their franchisees, you mentioned Subway. Subway does a lot of discounts. They send out a lot of mass coupons. They do a lot of they discount their entire menu digitally, which I no brand should do, to that extent, and then the franchisees have no choice but to sort of cut back. Although I don't know how you cut, like if you're a Subway franchisee, I don't know what other costs you can cut at this point. But anyway, we contrast that, like the penultimate example we have right now of a brand doing sort of things the right way is Chili's, right? To an extent, they got fortunate because, they were the beneficiary of some social media, but then, but what they did, and we were, definitely writing about this, is they took advantage of it. And what Kevin Hochman said was, okay, we understand that they're coming in, and people are coming in, based on a social media thing. But what we're going to do is we're going to make sure we keep them once they get in there. So what they've done is they've put money back into the operation. They've been investing behind labor. They're telling people it's okay to do that.
Right.
It's okay to invest in labor because that experience needs to be fantastic. And they're generating some really strong sales as a casual dining chain. So
I mean,
investing
and
behind the company is
they
important.
drove the category this last year because of that. And but that type of smart investment at the right time is important, because think about not being able to put your best foot forward when all of a sudden you have some sort of traffic influx that you're benefiting from, right? But they're able to do that. That labor investment is allowing them to wow their guests when they come in the door, to the point where they've reoriented their brand position with younger consumers. And that's a powerful thing to be able to do. And if you didn't make that investment, they wouldn't have potentially been in a position to capitalize on that. And that's I anecdotally, I think about my son who's in college. He's a bit of a food nerd, but Chili's is a place he would go to proudly, right? And he wouldn't say that about some of the other casual dining chains that I won't mention because it's not nice, right? But Chili's is one where he's like, Dad, this place was amazing. Me and my buddies go back all the time. And it was like, well, you live in Pilsen in Chicago and you have access to all sorts of other things and you're going everywhere to go to Chili's. He's like, well, where else can you get that deal? I'm a poor college kid. Right. And it's a great place to go have a drink. So it's, like that's not something I ever said or heard about Chili's before.
Right. Right.
And it's because of those investments they're making. So
yeah, I mean, it's important. Like, look, it's like historically, like one of the brands that has had a lot of challenges with franchisee bankruptcy and sales softness has been Burger King. Is a perfect example.
right.
And Burger King was always really, really good, very, very good at marketing. They could get attention. They were always really good at getting attention, and have had some amazing marketing people behind them.
Right.
The problem is, they would market and it would do really well for a very short period of time and they couldn't keep the people. And that's one of the challenges. Like a lot of brands today can get people in the door. They can get people to come in for a short period of time. That's not the challenge. The challenge is keeping them once they come in. And so you have to invest behind operations. It's not that exciting. I mean, operations people love operations, but I mean, it's vital. It's super vital to invest in your brand. And
I just think of my beloved Chicago Bears getting a fancy quarterback and no offensive line, right? Like, so it's sort of that same scenario where you're putting your star forward, but you're not necessarily setting them up for success if you don't have the operations to back it up. And they put out some pretty wonderful offers over the years, but if you're sending your customers into stores that aren't ready for it or can't execute on it, then you'll get the one-time bump, but you won't get the return visit.
Yeah. I want to switch gears a little bit and end this conversation on something we're talking about a lot these days. It's 5 years, by the way, 5 years since the COVID-19 pandemic, since that whole started. And on the surface, many of the things that we're talking about today, we were talking about in 2018.
Yeah.
Too many restaurants, shift to, social media marketing taking off, a lot of shift to technology and that sort of thing. From your standpoint, how do you think the restaurant industry is different today and how has it changed?
I think a lot of it has to do with probably a decade's worth of innovation around technology happening in a 2 to 3 year time span that maybe we weren't always ready for. The customers are more digital now. I don't know if we have a perfectly fluid marketplace for digital transactions yet. I mean, is fairly fragmented, especially if you want to own that ordering funnel as a restaurant. You have to rely on third party otherwise. And if you don't, you have to rely on them having one of 3 slots on their phone that they're willing to give to restaurants, which fragments the market pretty terribly. But I think all of the technologies that have entered the space, you can look at the conferences we all go to and the sponsors that flip from food and beverage to technology companies, pretty quickly. And I think a lot of that is, I think we're getting back to the basics a little bit now, but it's just now that we're just a slightly bit more digital market. The need states that drive behaviors are largely similar than they were before. I know the occasions we're going to are somewhat similar. The difference is there's just like maybe 10 or 15% more off-premise business happening depending on the segment you're in. And, the difference. So we just did this, conference for our supplier customers, and we did a study on day part dynamics and how they were shifting and what need states were driving on and off premise, breakfast, lunch, dinner, and snacking. And one of the things we saw was what appears to be social occasions disappearing from full service restaurants at dinner are actually just happening at home. There's still social occasions. They're large parties, people ordering 4 or 5 different meals and having either, having a Friday night at home. Right. And so there's just like a proportional difference in that. Right. The big thing is now we have all these cool technological tools we could potentially improve our business with. We're still learning how to use them though, I think.
Yeah. Yeah. I think I actually think one of the penultimate examples of where the industry has gone is actually in Starbucks.
Right.
Hear me out on this one. Is Starbucks has always been maybe arguably the most forward-thinking restaurant chain that we have. I think that's fair to say.
Yeah.
And they far ahead on loyalty than anybody else. And if you just go back to 2023, let's say early November 2020, early November, not late November, early November. That's really important. Early November 2023, and they were hitting it on all cylinders. Their sales were up close to double digits. They turned their customized beverages into $1 billion industry. Just like this, the extra pumps of whatever, people customizing, these young kids coming in, customizing their beverages because they watched on social media, turned into $1 billion business for them. They had mobile ordering they were generating a huge percentage of their sales through mobile ordering. Their loyalty members accounted for about 60% of their sales. So they were a machine. And then look what happened last year. Now there were probably a lot of different reasons. Social media turned against them very quickly, which is actually something that the industry has to contend with today. Chili's might do something tomorrow that just completely changes the narrative on social media because it can spread very quickly. Right. But then we suddenly were really, really concerned about these backups inside the restaurants, and there was this tension between what this restaurant had become, because this was a coffee shop. So the people spend their time all day hanging out and doing coffee shop things. And suddenly it became this churn thing, and it created this tension. And suddenly people didn't want to go as often because it wasn't what they were betting on, or maybe it was too expensive, or maybe social media narrative just kind of changed for the company. And what they've done in the last few months has kept me very busy. I can tell you that.
I'm sure.
And I think that's kind of, in some respects, where the industry is at right now. We've had this influx of technology. We don't know what to do with all of it. The industry really isn't very good in adding technology into its business. It's actually
it turns the relationship with the customer into something very transactional too. And not necessarily on purpose, but restaurant customers evaluate their experience just significantly more poorly when they've ordered through some form of technology. And some of that, and so the closer you get to a human, the more happy people are when it comes to their evaluation of the experience. And so, you think about all those people who are commuting during that time for your traditional morning drinks, going to a Starbucks, there are a lot of them that are on their app are ordering ahead to go pick up. Right. And if there's any sort of delay in that process for them on their commute or when they're traveling, 1 or 2 times could be enough to turn you away and try your competitor, if in that sort of thing. And there's no human there to kind of smooth over the problem, if you will, because everyone's over there customizing all the drink, the drink. Right. So I think there's a bit of there's like maybe what I'm reading in between the tea leaves from their strategy is they're trying to get a little bit, they want to capitalize on those transactional relationships, but they want to get back to that more human centered approach that they've been known for. So how can you balance those two things in the same space is really, I think, the big struggle that we're all coming to terms with. And it seems like they're starting to move in that direction, right? I think they possibly over relied on the app over time, because our concern coming out of the pandemic, because we kept hearing like, we're going to just have we're getting rid of all of our in-store seating. We're doing this and that. And, but I don't, that's not going to be a winning strategy for everyone. And in some cases, there's a really great Starbucks down the street from me. There's no inside seating. Makes sense because of where it sits. But near my son's high school, they need to have seating in there. They need to have people inside that store buying stuff, because those kids want to go have a place to hang out, right? Like there needs to be the right fit for the occasion that store can facilitate. And I think in many ways, brands like Starbucks maybe got a little too heavy on one type of hit, right? Instead of being a little bit more ambidextrous.
Yeah. Yeah. To me, I think it's fascinating. It's sort of a warning to the broader industry.
I still think Starbucks had a double whammy where they were, if you have Dutch Bros on the West Coast and Seven Brew on the East Coast, and they start moving towards the center, they're starting to deal with competition they never really had to deal with before. And both of those brands expanded significantly during that same time period that you're bringing up. As well. So it's, not just those two, but those are two examples.
Yeah. Yeah. Maybe I'm a little skeptical of that, simply because Dutch Bros is like a rounding error still to Starbucks. Starbucks is so big.
Yeah.
Starbucks is really, really big. But it's the point. They are going to have to deal with competition, because the coffee and beverage sector is just insane right now. And I think, probably Dutch Bros, you can see a definite scenario where they took a lot of those kids that were going to get the fancy drinks and probably don't have, the loyalty that most coffee drinkers like me have. I only go
right
in place over.
Kind of a little bit more shiny object type. I mean, they seem to be still finding success with those younger consumers, over and over again the last couple of years. So, we'll have to see where that nets out, as all of these beverage companies are trying to expand pretty dramatically. So I just think that from a footprint standpoint, Starbucks used to be the one that was surrounding the local market. There's now multiple brands that are starting to encroach upon their territory in ways that I think, even though they're a rounding error of one brand or the other, I think collectively the coffee chain market is potentially just really dense right now.
Yeah. Yeah. And there are only so many visits, and everybody wants a piece of it. And the thing is, like we mentioned Taco Bell earlier, they've got an entire plan to boost their beverage sales. McDonald's is going to go very big into beverages. I think eventually McDonald's sort of dismisses the idea of standalone cosmics and probably integrates the more popular beverage items into their regular menu. And if they start doing that, you're going to get a hell of a lot of competition. That beverage market is about to get flush with competitors, which really puts the onus on Brian Nickel over at Starbucks. And to your earlier point, balancing the need for more sales with being able to give consumers some sort of experience. You're threading a needle. That's tough.
It's tough. It's real tough, but I do think that it's possible. One thing I'm a little on the fence about in terms of where the coffee chain market's going. It's the first year in several where it's been flat. I can't tell if that's just Starbucks driving everything else down or not, right? It could be because they're just so big, but, I'm wanting to see how, if like Dutch Bros and Seven Brew and others can maintain the same trend lines this year, even if Starbucks has a similar year they did last year, then I'll feel better about the coffee chain market. But given where it ended this year, it's the first year it was not in significant positive territory in a while.
Yeah, that's tough. It's all right. We'll just have to wait and see what happens this year. Rich, this was fantastic. Really appreciate you joining me this week on the podcast.
No, thanks for having me. I appreciate it, as always. Anytime.
And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Spoons, artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. And you may subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening.